Alright, good evening. Let's continue from where we left off previously. Let me just get the pointer. Alright, so we're looking at the difference between book value and market value with an example here for Klingon Corporation. Okay, we're looking at long-term debt. The book value and market value is likely to be similar, the same, almost the same. Here you find there is a slight difference. Okay, and then the major difference would be here for net fixed assets. The book value would be 700 and the market value here it's about 1000. So the difference in net fixed assets between book value and market value is likely to be high. In this case it's positive, meaning the market value is greater than the book value. Sometimes, the market value can be lower than the book value. This can happen for both net working capital and net fixed assets. This happens when the company has problems, where the market value of the assets fall due to some reason. For example, there might be technological changes in the industry, and the company may be having assets which have no value now due to technological changes. Okay, then the market value will fall, where the book value will still be high, because that was the historical price at which the assets were obtained. Alright, in that case, then you will have a lower market value. In this case, it's higher, which is positive. And shareholders' equity, you find that there will also be a difference, but the shareholders' equity is largely due to the difference between the total book value and the total market value. The difference between the total book market value minus the total book value. In this case, it's 500, right? So here also, the total market value of liabilities and owner's equity must be the same as here. If it's 1,600 here, it must be also 1,600 here. Therefore, since the liabilities are 500, long-term debt is 500, so the shareholders' equity must be 1,100. There's no other way. Remember the balance sheet identity, it must hold both for book value as well as market value. And therefore this is 1,100. Therefore the shareholders' equity in terms of book value is 600. Therefore a difference of 500 here. This 500 relates the difference. The difference will be picked up by the shareholders' equity. So if the assets market value is greater than the book value, of course then the market value of equity will be greater than the book value of equity. So here you find that this 500 increase in 500 market value compared to book value of shareholders' equity arises from $200 difference in the market value compared to book value, plus another $300 difference in the market value compared to book value of net fixed assets. So this $500 difference comes from $200 difference here for net working capital and another $300 difference here from net fixed assets. This is because the book value and market value of long-term debt or debt in general, whether it's current liabilities or long-term debt, they're not likely to be very different. The market value and the book value is likely to be the same. Is that okay? Alright, so that's the difference between market value and book value. Market value can be higher or sometimes lower than the book value. Is that okay? Alright, let's move on. So with that, we finished the first part or first key point or key concept of this chapter, chapter 2. We have finished the balance sheet. Now we move on to the second key point or key concept in this second chapter, which is second financial statement. And this is called the income statement. This is different from the balance sheet. Now the income statement is more like a video. Compare this to balance sheet. Balance sheet is like a photo or a snapshot. But here it is a video. That means it describes the movement over time. Note this. For a specified period of time. That means it does not give you a picture at a point in time. It gives you a moving picture, if you like, not a photo, but a moving picture, a video, over a period of time, over a period of time, or over a period. Okay, so what does it tell you? It tells you the firm's operations. The idea is, the income statement reflects the company's or the firm's performance. The keyword is performance. Firm's operations or performance, over a period of time. But the balance sheet, on the other hand, gives you a snapshot of the financial position, not performance, but position. Balance sheet gives you the position, the income statement gives you the performance. Okay, so these are two different perspectives. Okay, so you need to know the difference. The keywords tell you the difference between income statement and the balance sheet. Okay, and so next we have defined the income statement. Next we look at the format, how the income statement is structured. Okay, so you generally report revenues first. Okay, so you start with revenue on the top. Okay, and then you deduct. Revenue means sales. What the company or the business gains in terms of revenue. Income, if you like. General income. Income is actually a more specific term. Whatever that is incoming in terms of revenue, we call that revenue or sales. And then from this sales we deduct, we minus expenses, for that particular period. So the revenue for the period minus the expenses for the period. That's the general format, or structure of the income statement. Okay, this income statement is derived, or structured based on the matching principle. This is an important principle in GAAP. What is GAAP? We call it GAAP, but it means generally accepted accounting principles. So it's based on a principle called matching. So what does matching principle tell you? It says, we must show revenue. When do you recognize? Show here means recognize. Recognize revenue. This is when the revenue is accrued. This is a new term for many students. Accrued. When the revenue is earned. Legally it is earned. That is what it means by accrues here. And then you match the expenses required to generate the revenue. So it's a very subtle but important implication here. So the income statement is based on the principle of matching, where first, you pin down the revenue for that particular period. You must define the period first. Usually it's for 1 year. Then in that year, we pin down the revenue. When the revenue is earned, not necessarily collected. So let's say, for example, you sell to your customer. This customer has agreed to pay you. So you secure the sales. The sales has been performed. So you have secured the sale. So the revenue has been earned. Therefore, you recognize the revenue for that period. The sales has been made. But not necessarily collected. Note that. You may not have collected from your customer, but you have already performed the sale. Now, GAAP says you can recognize the revenue. That means you can consider that you have made the sale. Not necessarily you have collected. Then you match this revenue with expenses. That you have incurred. Here you say accrue the revenue, but expenses that you have incurred in generating the revenue. For example, the purchases that you have made to make the sales, and also you may have used some assets that you have purchased earlier. Now here these expenses are required to generate the revenue, right? Therefore we match these expenses to the revenue. That is why we call this the matching principle. First we define the period, usually 1 year, that particular year, from which date to which date. Then we recognize the revenue within that period, when it was earned or accrued, and then we try and match the expenses that we have incurred, in order to generate the revenue for that period. Now these expenses may not be incurred in that particular period. It may be before that period or even after. In very rare cases, it can be after. But usually before this period. But we still recognize that as an expense for that particular period, because in that period this revenue has taken place. Is that okay? So this matching principle may seem very obvious, but if you think about it, there are very subtle principles, very specific, nuanced principles that you need to consider. Alright, we'll develop this some more when we look at the items in the income statement. Okay, now this is the format of an income statement, a very brief income statement of US Corporation in 2018. Usually when we say income statement, we say for the year ended 2018. For balance sheet, we say the balance sheet for US Corporation as at end of year 2018. For example, end of fiscal year 2018 or end of financial year 2018. But here we say for the year ended 2018, because it is for one period, not for one particular point in time. Okay, so we start with sales or revenue. We call this net sales. Okay, why net? Okay, sales or revenue means the same thing, but here we say net. Why? Because usually you make sales, but there will be some returns from your customer. For example, damaged goods and so on. When they return those goods, these are deducted from the gross sales. Therefore, you get net sales after deducting the returns. So here, we take the net value. We take net sales because it's a simplified, consolidated or aggregated income statement. And therefore, it means here that 1.5 million. This is $1 million. This billion. This is in million. Therefore, this is $1,509 million, which is about $1.5 billion. Of net sales, or revenue, was earned by US Corporation. Note this, it was earned, not necessarily collected, from the customer. This is what was earned, So this is based on the accrued principle. This was what was accrued by the company, That means earned by the company. Alright, then the cost of goods sold will be the cost, the expenses, of the items that was sold. This is actually an inventory cost. So this is the item of the, cost of the item sold in the sales. So this will be $750 million for that particular year, 2018. That means you used the value of $750 million of items. You sell it at this price. So this is roughly the cost of the sales that you have made. These are sometimes called cost of sales, but this will be the price at which you sold. This is the price. So this is the revenue that you made. This is the cost that you incurred to make this revenue. This is based on the matching principle as well. Note that this is based on the matching principle. This must match the revenue. So now the third item is depreciation. Depreciation is a very important item. Depreciation is actually, what do you understand by depreciation? Depreciation is normally understood as the reduction in the value of fixed costs. That is how many students understand, but it has a very specific meaning. Depreciation is actually the apportioning of fixed costs. Or apportioning here means division of fixed costs to the various years in which the fixed assets. The fixed assets are used. Alright, so we'll pick up on this depreciation in the next clip, because we are running out of time. But until the end of this clip, I'll try and explain what depreciation is. For example, let's say a fixed asset of 2 million, yeah,